If a book can change the way you see the world, this is where you'll find it. I'm Karo-chan. Let's explore together the books that truly shape our destinies. Today, the book we're diving into is Mastering the Market Cycle by Howard Marks. And if you turn left on your way out, you'll find another deep dive we did on his other classic, The Most Important Thing. If you're interested, go check that one out too. Have you ever had that frustrating experience of never getting the timing right? Back in 2021, you saw people around you making tons of money from funds, and you couldn't help but jump in. Then, in 2022, the market crashed, and you lost a big chunk of your principal. By 2023, you'd learned your lesson, didn't dare to move, and ended up watching the market quietly rebound, missing another chance. The truth is, it's not that we're unlucky or not smart enough. It's that we haven't seen through the invisible hand behind the market. The cycle. The author, Howard Marks, is a true legend on Wall Street. His firm, Oaktree Capital, achieved an average annual return of 19% over 22 years, on par with Buffett's Berkshire Hathaway. Even Buffett once said, "The first thing I read in my inbox is Howard Marks's investment memo." This book isn't filled with complex formulas or fancy theories. It's about one simple truth. Cycles aren't some kind of mystical concept. They're the compass of investing. As long as there are people and transactions, cycles will always exist. Only those who understand cycles can avoid stepping into traps and actually make money. You might be thinking, I just want to make some safe, simple investments. Why do I need to understand cycles? Well, cycles are actually a lot closer to your life than you think. The stocks you buy are influenced by the stock market cycle. The funds you invest in might hold bonds that follow the credit cycle. Real estate depends on both the credit and housing cycles. Even your bank savings and the return on your financial products rise and fall with the economic cycle. Take 2020, for example. During the pandemic, the economy cooled, the central bank cut interest rates, and your savings returns dropped. Then by 2023, as the economy recovered, rates started rising again. That's the cycle at work. And more importantly, cycles directly determine how likely you are to make money. Howard Marks gave a great example in the book. When he was investing in high-yield, junk bonds, he noticed something. When the economy was booming, even weak companies could easily borrow money. Everyone thought risk had disappeared. Buying junk bonds at that time usually led to losses later. But when the economy was struggling, even good companies' bonds were being dumped, and prices dropped sharply. That's when the real opportunities appeared. In short, the key to understanding cycles isn't about predicting ups and downs. It's about judging your odds of winning. Depending on where you stand in the cycle, your chance of making money can be totally different. A lot of people have a huge misunderstanding about cycles. They think this time is different. In 2000, during the tech bubble, people said the internet was a new paradigm and prices would never fall. In 2007, before the subprime crisis, people said housing prices only go up. In 2021, during the clean energy boom, people said it was the future trend and couldn't crash. And what happened? The cycle slapped us in the face every single time. After every big boom comes a big bust. After every crash comes a rebound. No exceptions. So today, we're not reading Mastering the Market Cycle to predict tomorrow's market perfectly. We're reading it to understand how cycles really work, how the economy, emotions, and markets affect one another, and how we can adjust our money strategy accordingly. So next, let's start with the most basic question. Why must we study market cycles when we invest? Once you get that foundation right, you'll be able to see the patterns clearly and learn how to deal with them wisely. In the last part, we talked about how the cycle is like the invisible hand of the market. Whether you're buying stocks, funds, or savings products, you can't avoid it. But some of you might still be wondering, I just want to earn some steady, safe money. Do I really need to study cycles? Here's the truth. It's not about whether you should study cycles. If you don't study them, you'll never truly earn steady money. First, you have to understand one core truth. Investing is essentially betting today's money on tomorrow's returns. But the future isn't fixed. Sometimes it's easy to make money. Sometimes it's hard. And what determines that difference? The cycle. Howard Marks used a brilliant metaphor. Investing is like gambling at a casino. You have to first read the table. Sometimes the cards are in your favor and your odds of winning are high. Sometimes they're against you, and your odds of losing are bigger. The cycle is like the compass that tells you where your odds stand. Let's take a real example. When Marks was investing in high-yield or junk bonds, he went through two completely different market environments. The first was in the early 1990s, when the U.S. economy was booming. Companies were making money easily, and banks were eager to lend. Even weak companies with poor credit could issue bonds without trouble. At that time, everyone in the market thought junk bonds were low risk and high return. People rushed in, pushing prices higher and higher. Marks and his team did the math. A junk bond only yielded about 5% a year, but if a company defaulted, you could lose half your money. The odds of winning were actually terrible, so they refused to buy. Sure enough, a couple of years later, the economy cooled. Companies started defaulting, and junk bond prices crashed. Those who bought at the peak lost big. The second time was right after the 2008 global financial crisis, and the situation flipped completely. Banks were terrified of taking risks. They wouldn't even lend to good companies. No one wanted junk bonds, and prices fell off a cliff. Bonds with a face value of $100 were selling for just $50, and still nobody wanted them. Marks and his team did the math again. If they bought a junk bond at that price, as long as the company didn't default, they'd get back $100 at maturity, an annual return of around 20%. Even if a few companies did default, the overall returns would still be excellent. So they went all in. Later, as the economy recovered and defaults dropped, bond prices climbed back to face value, and they made a fortune. See? Same bonds, same team, completely different results. The key is the cycle. Different positions mean different odds of winning. And that's the first reason why studying cycles matters. Cycles determine your win rate in investing. You've got to act more when your odds are high, and stay quiet when your odds are low. Otherwise, you'll just be working hard for nothing. Some people might say, well, I don't touch junk bonds. I only buy stable mutual funds. Surely I don't need to care about cycles, right? Actually, that's exactly when you should. Take stock funds, for example, something everyone's familiar with. At the start of 2021, the PE ratio of China's Chinext index shot up to 70 times earnings, higher than 95% of its historical levels. At that point, the cycle was clearly telling you, the odds are low because prices have already priced in future profits. The risk of a drop was huge. But many people looked at the 30% or even 50% gains from the previous year and thought, it'll keep going up. They jumped in. Then from late 2021 through 2022, the Chinext index fell by 40%, and the funds followed it down. On the flip side, by October 2022, the CSI 300 index had dropped to a PE of just 10, lower than 90% of historical levels. That's when the cycle was saying, odds are high now. Prices had fallen deeply, and the chance of a rebound was strong. But many investors, still scared from the previous crash, didn't dare to buy. Some even sold off their funds. Then, in early 2023, the market rebounded, and they missed the chance again. That's the real root of most investment losses, not understanding the cycle. People rush in when odds are low and pull out when odds are high, completely out of rhythm. Howard Marks actually pokes fun at this in his book. Most investors are like fish swimming with the tide. When the tide rises, they rush upward. When it falls, they panic and flee, never stopping to think when the tide might turn. Studying cycles helps you step out of that herd and actually see where the tide is flowing. Beyond win rate, the cycle also determines your payoff ratio. How much you can earn when things go right, and how much you can lose when they go wrong. Take the stock market again as an example. In a bull market, the cycle is in an upward phase. Company profits rise, investor sentiment is optimistic, and stock prices not only rise, they rise beyond expectations. At that stage, the payoff ratio is great. Earning 10% or 20% returns is pretty normal. But in a bear market, the cycle is in a downward phase. Profits drop, fear spreads, and stock prices don't just fall. They fall more than expected. That's when the payoff ratio turns terrible. Losing 10% or 20% is just as common. What's even more important is that cycle payoffs are asymmetric. If you buy at the bottom of a cycle, even if prices dip a little more afterward, the rebound that follows is usually much stronger. But if you buy at the top, even if prices climb a bit further, the drop that comes later will hit you much harder. For example, if you bought stocks in 2008, even after the October bottom, and they fell another 10%, by 2009 they had risen about 70%. But if you bought in 2007, even just before the October peak, and they went up another 10%, by 2008 they had fallen 60%. That's the second reason to study cycles. Cycles determine your payoff ratio. Buy at the right spot, and you take small risks for big rewards. Buy at the wrong spot, and you take big risks for small returns, or straight-up losses. Now, at this point, some of you might ask, if cycles are so important, does that mean studying them lets me predict tomorrow's ups and downs? Not at all. Howard Marks stresses this again and again. Studying cycles isn't about prediction, it's about adjustment. When win rates are high and payoffs are good, you should hold more aggressive assets, like stocks or equity funds. When win rates are low and payoffs are poor, you should hold more defensive assets, like bonds or cash. It's just like driving. You don't have to predict exactly where the next turn is, but you do need to know whether you're heading uphill or downhill. When it's uphill, you press the gas. When it's downhill, you hit the brakes. That's how you drive safely and efficiently. Investing works the same way. You don't need to predict tomorrow's market, but you do need to know what stage of the cycle you're in, and adjust your portfolio accordingly. That's the real purpose of studying cycles. So to sum it up, why must we study cycles? Because cycles determine both your win rate and your payoff. When you're in a favorable part of the cycle, your odds of making money are higher, and your gains can be larger. When you're in an unfavorable part, your odds shrink, and your losses grow. Not understanding cycles is like driving with your eyes closed. You might get lucky for a while, but eventually you'll crash. And to really make use of this cycle compass, we first need to understand the basic rules of how cycles move. They're not random or chaotic. They follow patterns. Next, we'll dive into the second part, the 3 core laws of cycles. Once you grasp these, you'll be able to see through market prices. And later, when we get into economic and emotional cycles, everything will make a lot more sense. Now that we understand why we have to study cycles, let's break them down even further. Market prices don't move randomly. There are 3 fundamental laws behind every cycle. These 3 principles are like the DNA of cycles. Whether it's the economy, the stock market, or real estate, they all follow the same logic. Once you grasp them, the market's ups and downs won't look chaotic anymore. You'll start to see the rhythm and the pattern behind the moves. The first law: a cycle never moves in a straight line. It always curves. The future may be bright, but the road is always winding. Howard Marks drew a famous chart in his book. One straight line represents the long-term trend. Say, the economy growing around 2% per year. The other is a wavy line that fluctuates above and below that trend. That's the real cyclical movement. He emphasized that nothing in the real world develops in a straight line. It's like climbing a mountain. You don't go straight up. You pause, step back, and then move higher again. Take the US economy as an example. Over the past few decades, the long-term trend has been around 2% annual growth, but the real numbers always swing around that line. When the economy is booming, growth can hit 4%. Like in 2021, when the US rebounded from the pandemic, GDP jumped 5.9%. When times are bad, it can even turn negative, like in 2020, when the pandemic hit and GDP fell by 3.4%. It's the same with China's economy. The long-term trend is still growth, but there are always slowdowns and short-term corrections in between. The key is, these curves aren't random. Inside every rise, there's already the seed of the next decline. And inside every fall, the next recovery is quietly building up. For example, when the pandemic hit in 2020, the global economy plunged. It looked terrible. But that crash pushed governments to launch massive stimulus policies, which laid the groundwork for the strong rebound in 2021. Then that rebound overheated the economy, driving up inflation, which in turn set the stage for the rate hikes and slowdown of 2022. The most common mistake investors make is treating short-term curves like long-term straight lines. When the economy rises for 2 years, they assume it'll keep going up and pile in more money. When the market drops for 3 months, they assume it'll keep falling and panic sell everything. But this first law reminds us, don't be fooled by short-term swings. Every rise turns into a fall, and every fall leads to another rise. See that pattern clearly, and you'll stop buying at the top and selling at the bottom. The second law, cycles are never identical, only similar. History doesn't repeat in detail, but it does repeat in pattern. A common trap for investors studying cycles is trying to find an exact match to the last one. They'll say, the last bear market lasted 18 months. Will this one too? Or, the last bull market tripled in size. Can this one do the same? But as Marx says, while the pattern of ups and downs tends to repeat, the scale, timing, and triggers are always different. Take China's stock market bull runs, for instance. The 2007 bull market was driven by real estate and heavy industry. It rose to 6,124 points and took a full year to crash. The 2015 bull market was fueled by leverage. It peaked at 5,178 and collapsed in just 3 months. The 2021 rally was a structural bull market, powered by new energy and consumer stocks, not a broad surge, and its decline was much slower. The details of these 3 bull markets were completely different, but the process was almost identical. It always starts with a few early believers, then the crowd piles in, then comes the frenzy, and finally, the bubble bursts. Bear markets follow the same script. In 2008, it was the subprime crisis. In 2018, it was trade tensions. In 2022, it was the Fed's rate hikes. Each time, the story changes, but the pattern repeats. A few start to turn bearish. Panic spreads to the majority. Investors dump their positions. And finally, after enough pain, the market bottoms out. The real value of this law is knowing what to focus on. Don't obsess over what's different this time. Look for what's similar. Are people overly optimistic again? Are asset prices disconnected from fundamentals? Is credit getting stretched to the limit? These repeating signals are the real clues that tell you where you are in the cycle. As Marx says, you don't need to remember how many points the last bear market dropped. Just remember, when everyone is scared, that's usually the bottom. The third rule is that cycles rarely stay in the middle. They usually swing to extremes. Just like a pendulum that hardly ever stops in the center, it always swings from one end to the other. This is the most essential yet counterintuitive rule of all. Howard Marks uses the image of a pendulum to describe cycles. Investor emotions, market valuations, and credit conditions all swing between 2 extremes, from greed to fear, from overvaluation to undervaluation, from easy credit to tight credit. The pendulum stays in the middle, rational zone for a much shorter time than you'd think. Most of the time, it's either moving toward an extreme or swinging back from one. The best example is investor sentiment. In 2021, during the new energy boom, emotions swung to extreme greed. No matter whether a company was profitable or not, as long as it had the new energy label, its stock price kept climbing. P/E ratios shot above 100 times. Then in 2022, when the sector corrected, emotions swung to extreme fear. Even companies with solid earnings growth saw their prices plunge, with P/Es dropping below 20. In reality, the fundamentals didn't change much. What changed was the emotional pendulum. The same goes for the credit cycle. Before the 2007 subprime crisis, credit swung to extreme looseness. Banks were handing out home loans to people without jobs or income proof. After the 2008 crisis, it swung all the way back to extreme tightness. Even high-quality companies had to go through layers of approval just to borrow a little money. That middle, moderately loose period only lasted briefly around 2009. This rule gives us the most direct warning. When the market reaches an extreme, don't assume it will stay there. Always remember the pendulum. It will definitely swing back. For example, when you see everyone rushing to buy a certain kind of asset, be alert. It might be nearing the extreme of greed. When you see everyone dumping a type of asset, think, maybe it's close to the extreme of fear. In 2007, at the peak of the market, Howard Marks wrote a memo titled, "It's All Good." He listed 10 reasons why everyone believed nothing could go wrong, and ended by saying, when everyone believes nothing can go wrong, that's usually when the trouble begins. The subprime crisis that followed proved his point perfectly. Together, these 3 rules form the basic framework of cycles. They move in curves, repeat in similar patterns, and always swing to extremes. Once you understand these 3, you've basically mastered the universal language for analyzing cycles. No matter whether we're talking about the economic cycle, the emotional cycle, or the credit cycle, these 3 rules always apply. Ask yourself, where are we now on the curve? Has it already reached an extreme? Which past cycle does this one resemble? And to truly apply these 3 rules in real investing, we need to go one step further. Break down which specific cycles are shaping our decisions. For example, the economic cycle determines the overall environment, the emotional cycle drives market sentiment, and the credit cycle controls how easy it is to borrow money. Next, we'll move into the third part, breaking down the 9 key cycles one by one, so you can see how they interact and, more importantly, how to respond. After understanding the 3 major rules of cycles, we need to bring it down to real life. Which cycles are actually affecting our wallets? In his book, Marx divides the key cycles into 3 types. Fundamental cycles. They decide whether the overall environment is good or bad. Psychological cycles. They decide whether people dare to buy or not. And market cycles. They determine whether specific assets go up or down. Each category has 3 subcycles, 9 in total. These 9 cycles aren't separate. They're like gears, interlocked and moving the market together. Let's break them down one by one, in plain language. The first type is the fundamental cycle, the logic underneath the economy, the government, and the corporations. Think of this cycle as the roots underground. It determines the long-term trend of the market. It's like farming. The economy is the soil, the government is the weather, and the companies are the farmers. If the soil's good and the weather's right, the crops grow well. If not, everything struggles. The first fundamental cycle is the economic cycle. At its core, it's all about GDP growth. But you need to look at it on 2 levels. In the long run, the fundamentals depend on 2 main drivers: population and productivity. Take China's past 20 years, for example. The rapid growth came from the demographic dividend, meaning there were lots of working people, and from technological progress, like upgrades in manufacturing. Now growth is slowing because the population is aging and productivity gains are fading. These factors change slowly, like soil fertility. It takes years, even decades to shift, and it determines whether the economy trends upward or downward over the long term. In the short run, it's driven by sentiment and inventory. When the economy's good, companies think demand will keep rising, so they ramp up production until inventories pile up. Then they're forced to cut back and the economy cools down. When the economy's bad, companies stop producing, inventories run out, and then they have to restock. That's when things pick up again. For example, in 2023, when domestic consumption recovered, home appliance companies were cautious at first and didn't stock much. Then they realized sales were booming and quickly increased production. That's a short-term swing caused by inventory cycles. We don't need to memorize GDP data. Just know this: the economy is never always good or always bad. It moves upward in the long run, but it swings up and down in the short term. That's the essence of the economic cycle. The second type of fundamental cycle is the government regulation cycle. The government acts like a gardener. When the economy overheats, like when inflation is high, it waters to cool things down. When it's too cold, like when unemployment rises, it fertilizes to warm things up. They mainly use 2 tools: monetary policy and fiscal policy. Monetary policy is when the central bank adjusts interest rates and prints money, In 2020, during the pandemic, central banks cut rates. Borrowing got cheaper, so companies invested more. In 2022, inflation rose. They hiked rates. Borrowing got expensive, companies pulled back, and the economy cooled off. The second tool is fiscal policy. The government spends money and cuts taxes. For example, in 2023, when they issued consumer vouchers, that was meant to encourage people to spend. Tax cuts help companies earn more and hire more people. But keep in mind, the government can mess up too. In 2000, the US Fed cut rates too aggressively. There was too much money flowing. People rushed into real estate, and that fueled the subprime crisis later. In 2021, some local governments overstimulated the economy, which caused inflation to rise again. So government intervention isn't a magic cure. It can actually add to the cycle's ups and downs. The third fundamental cycle is the corporate profit cycle. Corporate profits are like a magnifying glass for the economy. When GDP grows 10%, company profits might jump 20%. When GDP drops 10%, profits could plunge 20%. That's because of two main levers. The first is operating leverage. Companies have fixed costs like factories and equipment. When revenue rises a little, profits jump a lot. When revenue falls a little, profits fall even more. For example, if a factory has fixed costs of $1 million and revenue is $2 million, profit is $1 million. If revenue rises to $2.2 million, profit increases to $1.2 million. But if revenue drops to $1.8 million, profit falls to $800,000. That's operating leverage at work. The second lever is financial leverage. The more debt a company takes on, the more fixed its interest payments are, which means its profits swing even more. In 2022, many real estate developers blew up because they'd borrowed too much. When housing prices dropped just a little, their profits vanished, and they couldn't even pay the interest. So when looking at profits, don't just see how much a company makes. Check how much leverage it has. High leverage means profits soar faster when times are good, but crash harder when things turn bad. Now let's look at the second category, the psychological cycle, the emotional pendulum of investors. If fundamental cycles are the hardware, then psychological cycles are the software. Even if the economy and companies are strong, if people feel pessimistic, the market won't rise. But when sentiment is good, even with mediocre fundamentals, the market can go crazy. The first form of the psychological cycle is the emotional pendulum. Marx's most famous metaphor is exactly that, a pendulum. Investor emotions constantly swing between greed and fear, and rationality only stays in the middle for a split second. We see this all the time. When greed takes over, everyone's buying. If I don't buy, I'll lose out. This is the new trend. It'll go up forever. When fear hits, if it drops again, I'm doomed. Sell it now. This company's finished. I wouldn't buy it even if it's cheap. The irony is, when emotions are the most greedy, that's usually the top of the cycle, like new energy stocks in 2021. When emotions are the most fearful, that's often the bottom, like China's A shares in October 2022. We all know not to crowd where it's too packed when we shop, but in investing, we still follow the crowd. That's the trap of the psychological cycle. The second form of the psychological cycle is the risk attitude cycle. Many people think high risk means high return, but Marx reminds us, risk isn't about volatility, it's about the possibility of loss. Cycles change how people see risk. When the market's good, everyone thinks risk is their friend. They rush into risky assets. Before the 2007 subprime crisis, banks even lent money to people without jobs, believing home prices would never fall. Risk didn't seem real. When the market's bad, risk suddenly becomes the enemy. After the 2008 crisis, some people were too scared to even buy government bonds. They thought banks might collapse and they couldn't withdraw their money. The key lesson from this cycle is simple. The most dangerous moment is when everyone believes there's no risk. The safest moment is when everyone thinks there's nothing but risk. For example, in 2023, everyone was terrified of the Fed's rate hikes and didn't dare buy US stocks. But when rate hikes were nearly done, the market rebounded instead. That's how you make money, by understanding the risk attitude cycle. Finally, let's look at the third type: market cycles, credit, real estate, and the stock market. This type of cycle is the result. It's where the changes in fundamentals and psychology eventually show up in real assets. The stock market, housing prices, and investment returns we care about every day are all affected by these three cycles. The first market cycle is the credit cycle. Basically, how easy or hard it is to borrow money. Credit is the lifeblood of the economy. When it's easy for companies to borrow, they can expand production. When it's easy for consumers to borrow, they can buy homes and spend more. But when credit tightens, everything slows down. The essence of this cycle lies in how the credit window swings wide open and then suddenly slams shut. When the window is wide open, banks are eager to lend. Interest rates are low, approval standards are loose. After the 2020 pandemic, it was easy for companies to issue bonds, even those with mediocre credit ratings. People could buy homes with low down payments and cheap mortgages. When the window closes, banks stop lending. Rates rise and approval becomes strict. After the Fed raised rates in 2022, it became much harder for companies to issue bonds. And even when they did, the interest was much higher than before. For homebuyers, down payments increased, and mortgage rates went up too. Marx calls the credit cycle the king of all cycles. It amplifies both the ups and downs of the economy. In 2007, easy credit pushed real estate prices higher. In 2008, tighter credit burst the bubble. So before investing, ask yourself, is it easy to borrow money right now? If it is, the market might be near the top. If it's hard, the market might be close to the bottom. The second market cycle is the real estate cycle, which is really about supply and demand mismatch. It moves slowly, but that's because construction itself is slow. There are three key traits to this mismatch. First, the long construction period. From acquiring land to delivering homes takes 3 to 5 years. By the time the buildings are done, demand may already have cooled. For example, many developers bought land in 2018. When the homes were finally completed in 2021, the market had already cooled, and those houses just sat there, unsold. Second, developers tend to swarm in. When they all think they can make money, they build at the same time, and that leads to oversupply. Think about the ghost cities in China's third and fourth tier cities. Developers all rushed in, built together, and in the end, no one came to buy. Don't believe the saying that housing prices always go up. Marx gives an example in his book. In one area of Amsterdam, home prices, after adjusting for inflation, took 350 years to double. There's no such thing as an asset that always rises. Real estate has cycles too. Before you buy a house or a real estate fund, ask yourself, is everyone rushing to buy right now, or is everyone too scared to touch it? Don't fall for the "it always goes up" story. The third market cycle is the stock market cycle, the one that contains all the others. The stock market is a kaleidoscope of cycles. Changes in the economy, psychology, and credit all show up here. And it has three defining traits. First, the 3 stages of a bull market. It starts when a few people turn optimistic. Prices rise a little. Then more people notice and join in. Prices rise more. Finally, everyone's bullish. Prices soar. And people start chasing like crazy. Second, the 3 stages of a bear market. It begins when a few investors turn pessimistic. Prices drop slightly. Then more start to agree. Prices fall further. Eventually, everyone turns negative, and that leads to panic selling and a full-on crash. Third, markets rise slowly but fall fast. A bull market inflates like a balloon, slowly. A bear market deflates like one too, but much faster. During the 2020 pandemic, the market fell in just 1 month, but it took 3 months to climb back. When buying stocks or stock funds, don't just look at how much they're up today. Ask yourself, which stage of the bull market are we in? Is everyone getting crazy? If yes, it's time to be cautious. If everyone's scared, that's actually when you should start paying attention. These 9 cycles don't operate separately, they interact. A strong economy boosts corporate profits, which lifts investor sentiment. Then easy credit fuels rising stock prices and higher housing prices. On the flip side, a weak economy hurts profits, which triggers pessimism and fear. Credit tightens, and eventually, both stock and housing prices fall. Once you understand these linkages, you won't look at things in isolation, like stocks are up or housing is down. You'll see the underlying cycle at work. For example, the rebound in China's A shares in 2023 came from three forces combined: economic recovery, improving sentiment, and loose credit. And once you know which cycles are in play, the next question is, how do you respond? For instance, if credit is loose but sentiment hasn't gone extreme yet, should you hold more stocks or more bonds? In the next part, we'll get practical, the 3 key steps to deal with cycles so you can turn your understanding of them into real profits. Earlier, we broke down the logic of the 9 types of cycles, and we know how the economy, emotions, and markets are interconnected. But for regular folks like us, just understanding isn't enough. The key is knowing how to adjust our wallets based on these cycles. In his book, Marx condenses the practical method into 3 steps: insight, courage, and preparation. These 3 steps are interlinked. Missing one could mean all your efforts go to waste. Step 1. Take the market's temperature. It's about understanding where we are in the cycle right now. Sometimes it's not about predicting whether the market will go up or down tomorrow, but about figuring out which stage the cycle is in. Is it at the top, the bottom, or somewhere in between? It's like a doctor taking a patient's temperature. You don't need to know when they'll get better, just whether they have a fever or not, and how to measure that temperature. Marx gave 2 simple and useful dimensions. The first dimension is the valuation level, the alignment of asset prices with fundamentals. For example, in the stock market, you look at the PE ratio and the price-to-book ratio, and how they compare to historical levels. If the PE is above 90% of its historical range, it means stock prices have outpaced earnings, and we might be at the top of the cycle. If it's below 10%, the stock has probably dropped too much, and we could be near the bottom of the cycle. In October 2022, the PE ratio of China's CSI 300 index dropped to 9.8x, which was in the 8th percentile historically. That's a sign of low temperature, and the chances of a rebound were very high. In early 2021, the PE ratio rose to 16x in the 85th percentile historically. That's a sign of high temperature, and the chances of a drop were higher. Real estate is the same. For instance, we look at the price-to-income ratio. That's the house price divided by a family's annual income. If it's 50% higher than the historical average, it means house prices are too expensive, and we might be at the top. If it's 30% lower than the average, house prices are cheap, and we might be near the bottom. You don't have to calculate complex data, because many financial apps provide these indicators historical percentiles. It's easy to understand at a glance. The second dimension is emotional indicators. Look at people's behavior. Are they acting extreme? For example, look at fund subscriptions and redemptions. If new fund issues are selling out fast and everyone's rushing to buy, it's a sign of greed. We might be at the top. If there's a massive redemption wave and everyone's scared to hold, it's a sign of fear. We might be near the bottom. In 2021, during the new energy fund rush, some funds raised hundreds of billions in a single day. That's a greed signal. In 2022, many funds dropped more than 20% in value, and redemptions doubled. That's a fear signal. A simpler way is to watch the people around you. If even the aunties at the market are talking about stocks and buying funds, it's a sign we're nearing the top. If no one dares to talk about investing and just sighs when you bring it up, it's a sign we're nearing the bottom. Marx said the extreme states of the market are never calculated with data. They're seen by observing people's behavior. Sometimes the key is not to get distracted by short-term fluctuations, but to focus on whether valuations are extreme and whether emotions are extreme. As long as these 2 signals haven't reached an extreme, there's no need to panic. Once they do, it's time to prepare to adjust your positions. This is the foundation of managing market cycles. Step 2. Have the courage for counter-cyclical action. When others are greedy, be fearful. When others are fearful, be greedy. After you understand where we are in the cycle, the real test is whether you dare to act. Many people know the market is at the bottom but are too scared to buy, or they know it's at the top but can't bring themselves to sell. That's a lack of courage. In his book, Marx shared his own experience with counter-cyclical investing. After the collapse of Lehman Brothers in 2008, there was panic in the market, and bond prices dropped drastically. Bonds with a face value of $100 were being sold for just $50, and no one wanted them. At the time, his team was receiving redemption requests from clients every day. Everyone was scared and wanted to pull out their money. But Marx did the math. Most of the issuers of those bonds were solid companies, just temporarily facing cash flow issues. As long as the companies didn't go bankrupt, they'd get back the $100 principal when the bonds matured, with an annualized return of 20%. He held strong, didn't redeem the bonds, and even persuaded institutional clients to add more investments, spending $5 billion a week on buying bonds. Later, the economy rebounded, and bond prices returned to face value. That move made a lot of money. On the other hand, during the tech bubble in 2000, everyone was rushing to buy internet stocks. Even companies that weren't making a profit saw their stock prices increase by 10 times. Marx's team thought the valuations were ridiculous, so they resolutely didn't buy, and even sold off the tech stocks they already held. Later, when the bubble burst, tech stocks dropped by 80%, and they successfully avoided a big loss. What's hard about counter-cyclical investing? The hard part is holding on. If you buy, it could still drop. If you sell, it could still go up. After Marx bought bonds in 2008, the stock market dropped another 10%. Clients were calling him every day with doubts. In 2000, after he sold the tech stocks, the market went up another 20%. Some people said he missed out on opportunities, but he held firm, relying on his confidence in the cycle. And in the end, he proved to be right. How do you build courage? Marx gave a piece of advice. Don't try to buy at the absolute bottom and sell at the absolute top. Just buy when it's relatively low, and sell when it's relatively high. For example, if you think we're at the bottom, don't go all in at once. Spread it out over 3 to 6 months and buy gradually. If you think we're at the top, don't sell everything all at once. Do it gradually over several rounds. That way, even if you're wrong in the short term, you'll have room to adjust, and you won't be paralyzed by fear of making a mistake. Step 3. Be prepared and plan for mistakes. Don't put all your eggs in one basket. Even if you have insight and courage, you can't guarantee that you'll always be right about the cycle. You might think we're at the bottom, but then an unexpected policy change or external shock could cause another 15% drop. At that point, being prepared becomes crucial. You need good risk control so that one mistake doesn't wipe out all the gains you've made. When preparing, there are 3 things you need to do. The first is to leave a margin of safety. When buying assets, the price should be much lower than its intrinsic value. For example, if you calculate a stock's value to be $10, don't buy it at $10. Wait until it drops to $8. Even if it drops more later, it won't drop much further. Marx says that a margin of safety is like a seatbelt in a car. You don't need it every day, but it could save your life when things go wrong. For example, in 2022, if you bought consumer stocks and left a 20% margin of safety, even if the stock price fell another 10%, you wouldn't lose too much. If you bought at the peak, you could lose 30% or more. The second is diversification. Don't put all your money into one type of asset. For example, if you have $1 million, don't put it all into stocks. Distribute it. $400,000 in stocks, $300,000 in bonds, $200,000 in cash, and $100,000 in gold. That way, even if the stock market drops, the bonds might go up, and the cash will act as a safety buffer. You won't lose everything because one asset falls. Marx's funds never invest more than 20% of their money in any single asset, precisely to deal with the uncertainty of market cycles. The third is controlling leverage. Don't borrow money to invest. A lot of people think leverage helps you make more money, but during a downturn, it amplifies your losses. In 2022, some people took 3x leverage to buy stocks. and when the market fell 30%, they got liquidated, losing all their capital. If they hadn't used leverage, even with a 30% drop, they'd still have 70% of their principal left, giving them a chance to recover. Mark says leverage is a double-edged sword. It helps you earn more when prices go up, but it makes you lose faster when prices fall. Ordinary people should avoid it. The core of being prepared is not to treat investing like gambling, but as a long-term career. Even if you make one wrong judgment, with good risk control, you can survive and wait for the next opportunity. As Buffett said, the biggest secret to investing is staying alive. That's the essence of it. These 3 steps, practical skills are the foundation, courage is the key, and preparation is the guarantee. But we need to be clear-headed. Even if we do these 3 steps perfectly, it doesn't guarantee we'll win every time. Cycles have limitations, and we're not gods. We'll always make mistakes in our judgment. In the next section, we'll talk about the pitfalls to watch out for when responding to cycles, how to accept imperfection, and how to survive in the long run during cycles. Earlier, we talked about the 3 steps for navigating cycles. Some people might think that as long as they have the right knowledge, courage, and preparation, they can always make money in these cycles, right? But Marx repeatedly points out a counterintuitive truth in his book. Even if you fully understand the cyclical patterns and execute your strategy perfectly, there are still inherent limitations when dealing with cycles. You can't always be right, and you can't always time everything perfectly. In this section, we'll dive into these limitations, not to deny the methods we've discussed earlier, but to avoid falling into the trap of thinking that understanding cycles means you won't lose. We need to keep a clear, rational mindset. The first limitation is that even if you understand the cycle, you might be ahead of the curve, and that could actually be wrong. In his book, Marx recalls a case that left a strong impression on him. In the mid-1990s, U.S. tech stocks started gaining momentum. A group of cautious investors calculated the valuations and found that tech stocks were massively overpriced compared to their earnings. So, they began shorting and selling them early. From a cyclical perspective, they were absolutely right. Tech stocks were indeed building up a bubble, and they were bound to crash eventually. But the problem was, the bubble didn't burst that quickly, and tech stocks continued to rise for another 3 years. Those who were shorting lost badly compared to the market. Their clients kept questioning whether they were missing the new trend, and eventually, they were forced to redeem their funds. Many investors didn't wait for the bubble to burst in 2000 and had already exited the market. Marx referred to this as investing too early. It's not any different from being wrong. Why did this happen? Because the timeline of cycles is uncertain. You might be able to spot that we're at a peak, but you don't know how long that peak will last. You might spot the bottom, but you don't know how long the bottom will drag on. It's like in October 2022, when many people thought the Chinese stock market had bottomed out and started buying in. But the market then went sideways for 4 months. During that time, some people couldn't hold on any longer because it wasn't going up and sold off, only for the market to rebound right after they sold in early 2023. The mistake most ordinary people make is equating the direction of the cycle with the timing of it. They think that once they identify the right direction, they'll start making money right away. But in reality, while it's easier to judge the direction of a cycle, it's much harder to time it. You might get the direction right but lose on the timing, and eventually, because you can't hold on any longer, you give up, which actually turns out to be the wrong decision. This isn't about whether you understand cycles or not. It's the inherent uncertainty of cycle timing that makes it impossible for anyone to precisely nail every step. The second limitation is that cycles have randomness, and black swan events can disrupt your judgment. Marx quotes a professor from the London Business School, Roy Dimson, who said, "Risk means that the number of things that could happen is greater than the number of things that will happen." This means that cycles have patterns, but that doesn't mean there are no surprises. There are always black swan events that you couldn't have imagined when studying cycles, and they can suddenly disrupt the rhythm of the cycle. A typical example is the 2020 pandemic. At the end of 2019, many institutions analyzed that the economy would recover moderately in 2020, and the stock market would steadily rise. From a cyclical perspective, that judgment was correct. The economy was in a recovery phase, with loose credit and improving corporate profits. But no one anticipated that the pandemic would suddenly break out, pressing the pause button on the global economy, and the stock market fell by 30% within a month. All the previous cyclical predictions were completely disrupted. Those who had invested based on the recovery cycle couldn't avoid the massive drop, even if their steps had been right. There was also the Federal Reserve's interest rate hike in 2022. At the end of 2021, most people thought the rate hikes would be moderate, but inflation exceeded expectations, forcing the Fed to raise rates significantly. Global stock and bond markets both fell, and many investors who thought the bond market would stabilize also lost money because of this unexpected change. These cases tell us that cyclical patterns are highly probable, but not inevitable. By studying cycles, you can increase your chances of making money, but you can't rule out the possibility of black swan events. Even if you have good risk control measures in place, like diversifying your investments and leaving a safety margin, you can only reduce losses, not completely avoid them. This is the limitation of randomness in cycles, and no one can avoid it. The third limitation is that human ability has its boundaries, and you can't always respond rationally. The core of cycles is counterintuitive, being fearful when others are greedy, and being greedy when others are fearful. But we're all ordinary people, not machines, and it's inevitable that emotions will influence us. Even if you understand the cyclical patterns, you may still deviate from your plan because you can't hold on. Marx himself admits that after managing funds for decades, he's also hesitated because of emotional fluctuations. For example, in 2008, when buying bonds, clients called him every day, questioning if he had gone crazy for buying falling assets. He even wondered if he had made the wrong judgment. In 2015, during the A-share bull market, when everyone around him was making quick money, he also felt the urge to increase his stock allocation. But through years of experience and discipline, he managed to suppress those emotions. However, it's hard for ordinary people to do the same. Another, more practical issue is that you can't always maintain sharpness in understanding cycles. For example, after making money for several consecutive years, you might get cocky, thinking you've mastered the cycle, and let your guard down. In 2021, many fund managers who were making money found themselves losing even more in 2022 because they became too confident and ignored the turning points in the cycle. On the other hand, after losing money for several years, you might get frustrated, thinking cycles don't work at all, and abandon the methods you used before. In 2022, many people cut their losses in funds, but in 2023, they missed the rebound because their confidence was shattered by the losses. This is the limitation of human ability. You can improve your ability to navigate cycles by learning, but you can't eliminate human weaknesses, and you can't always stay at your best. At the core, navigating cycles is a battle between you and yourself, and in this battle, no one can always win. At this point, someone might ask, since there are so many limitations in navigating cycles, does studying them still have any meaning? Of course it does. Marx once said, studying cycles is not about being right every time, but about making fewer mistakes and avoiding blowing up. Once you accept these limitations, you won't deny the cycle because of one wrong judgment, and you won't become arrogant after one success. You'll understand that navigating cycles is a long-term game. As long as you can identify the right direction most of the time, control risks well, and survive through the ups and downs of each cycle, you'll eventually make money. More importantly, these limitations will also help you understand that success itself is not permanent. Even if you made money through cycles, you could lose it in the next cycle by becoming overconfident and ignoring the limitations. This brings us to the next topic we'll discuss. Success itself also has cycles. How do we avoid turning success into the seed of failure and become long-term winners in cycles? Earlier, we talked about the limitations in navigating cycles, and even if you make money by understanding cycles, you could still trip up because of oversight. But Marx throws out an even more counterintuitive idea in his book. It's not just the economy and the stock market that have cycles. Success itself has cycles. Success quietly plants the seeds of failure, and failure, in turn, can lay the groundwork for success. A lot of people think success can be copied, that once you win, you'll always win. But the reality is, the more successful an area is, the more likely it is to hide the risk of a crash. On the other hand, places that no one believes in may actually harbor new opportunities. In this section, we'll break down the logic of success cycles and understand why you can win and then lose, and why you can lose and then win. First, we need to understand why success breeds failure, and the core reason is the pursuit of profit by capital, combined with human greed. Any method that can continuously make money, as soon as too many people know about it and start copying it, will slowly lose its effectiveness. Marx shares a personal experience in his book. In the 1980s, when he first started investing in junk bonds, very few people were paying attention to this field. The prices of junk bonds were very low, and the annual returns could exceed 15%, with a low default rate. Using this strategy, he made a lot of money. But good times don't last long. Once junk bonds became profitable, banks, funds, and insurance companies all rushed in. Everyone started buying junk bonds, pushing the prices higher and higher, but the returns kept getting lower, from 15% down to 8% and even 6%. What's worse is that, to win projects, many institutions started lowering their approval standards, issuing bonds to companies with worse credit ratings, which ultimately led to a surge in default rates. The once profitable junk bond strategy suddenly stopped making money and even started losing money. This is the first trap of the success cycle. Successful methods attract too much capital, turning profitable opportunities into losing traps. We see plenty of examples like this around us. In 2020, consumer funds performed well, rising over 40% in a year, and everyone jumped on the bandwagon. In 2021, the market launched hundreds of consumer funds, with funds piling into consumer stocks. As a result, consumer stock valuations rose to historical highs, and in the second half of 2021 they started falling, with many consumer funds losing over 20%. The same thing happened with new energy funds in 2021. Everyone bought in, and then in 2022, the new energy sector dropped by 30%, and the money that was made earlier was wiped out. Why does this happen? Because capital always chases profit, just like bees are drawn to where the scent is. Wherever there's money to be made, capital rushes in. But the profit space for any asset is limited. When too much capital floods in, it's like too many people squeezing into an elevator. The elevator becomes overloaded, and in the end, no one can go up, or it might even break down. Marx calls this phenomenon crowded trading. When too many people are doing the same thing, that thing stops being profitable, and the strategies that tend to fall into crowded trading are often those that were successful in the past, because people see others making money with them and think, I can make money too, only to end up blocking the path for everyone. The second trap in the success cycle is that success makes people overconfident and ignore the risks of cycles. Once people make money with a certain method, it's easy for them to feel like they've mastered the eternal truth, forgetting that cycles change and markets change. Marx mentions a phenomenon he observed in his book. Many fund managers who outperform the market for 3 to 5 years become extremely confident, thinking they're smarter than the market, and start deviating from their original strategy. For example, those who originally did value investing start buying growth stocks after seeing them rise. Those who were cautious about position sizing begin using leverage to expand their scale. And then, when the cycle turns, like when growth stocks fall and leverage blows up, those once successful fund managers' performance drops sharply. Here's a real case that's very typical. Around 2000, a fund manager made money by investing in tech stocks, outperforming the market for 5 consecutive years with annual returns of over 30%, becoming a star manager of that time. He believed that tech stocks were a new paradigm that wouldn't fall, and invested 90% of his fund in tech stocks, even adding 2 times leverage. Then, in 2000, the tech bubble burst, and the stocks dropped by 80% in a year. His fund not only lost all the money it had earned, but also lost 60% of the investor's capital. Eventually, the fund was liquidated, and he left the industry. Marx commented on this saying, Success makes people forget about cycles, and they always think they can escape the cycle. This is the most dangerous illusion. We ordinary people are the same. For example, if you made money by buying a certain stock, you might think it will always rise and invest all your money in it. Or if you made money with a certain industry fund, you might think that industry will always do well, and buy it no matter how high the valuation is. Actually, this isn't about understanding investment. It's about being blinded by success. Success itself makes people relax their vigilance towards cycles, and cycles are best at delivering fatal blows when people let their guard down. But on the flip side, failure also breeds success. That's the other side of the success cycle. Why? Because failure clears out crowded capital, allowing undervalued opportunities to resurface. For example, if a certain investment strategy is losing a lot, people get scared and pull out their funds, which drives the price of these assets down to very cheap levels, and valuations drop to historic lows. At the same time, institutions that were making money from this strategy either shut down or pivot, which reduces competition, and the remaining institutions can buy quality assets at low prices. Then, when the cycle rebounds, they make a huge profit. Marx's Oak Capital was founded on this principle, finding opportunities in failure. In the early 1990s, the U.S. real estate market collapsed, many real estate funds went bankrupt, and no one dared touch real estate. But Marx's team found that many quality real estate projects, because developers didn't have enough money, had dropped in price by more than 50%, and no one was fighting to buy them. They took advantage of this, buying these projects at low prices, and when the real estate cycle warmed up and housing prices went up again, they made several times their initial investment. Later, during the 2008 financial crisis, they used the same approach to buy a lot of defaulted bonds and unfinished buildings at low prices, and once again made huge profits. This is how failure breeds success. Failure scares too many people away and brings down overpriced assets, leaving behind those who can pick up quality assets for a bargain. Just like in 2022, the value investment strategy in China's stock market lost heavily, with many value funds' net worth dropping by more than 20%. Everyone rushed to redeem their value funds and buy growth funds instead. In 2023, value stocks rebounded by 15%, while growth stocks continued to drop. Those who stuck with value investing and weren't scared off by failure ended up making money. The counterintuitive point here is that everyone thinks success should be copied, and failure should be avoided. But the reality is, success is hard to replicate, and failure hides opportunities. Because when success happens, the opportunities have already been grabbed by too many people. While during failure, no one wants those opportunities, and they become forgotten treasures. Marx said that the most profitable investment opportunities are often in places where everyone thinks failure will continue. Because everyone avoids them, the price becomes cheap, and the chances of winning become larger. To summarize the pattern of the success cycle, any successful investment method or asset strategy will become unprofitable because of capital inflows. Any failed investment method or asset strategy will become profitable because of capital outflows. Success and failure swing like a pendulum. There's no such thing as permanent success, and no such thing as permanent failure. Once we understand this pattern, we can break free from the trap of chasing success over avoiding failure. For example, if you see a certain asset or strategy has been successful recently, don't blindly follow the crowd. Think about whether too many people are doing it. If you see a certain asset or strategy has been failing recently, don't panic and cut your losses. Think about whether no one is doing it and if the price has become cheap. This is actually an extension of the cycle pattern. Success and failure follow mean reversion. What goes up too much will come down. What goes down too much will rise. Success will eventually lead to failure, and failure will eventually lead to success. To be a long-term winner in the success cycle, there's one key piece of advice. Don't be arrogant when you succeed, and retreat when you see the crowd. Don't get discouraged when you fail, and focus when things are quiet. This is essentially the same as the contrarian approach we talked about earlier in cycle positioning, except now we've extended the cycle perspective from economics to success itself. At this point, we've broken down the core logic of cycles. From understanding the rules of cycles, to analyzing specific cycles, to implementing strategies to navigate cycles, and finally, the cycle of success itself. The most important phrase in the entire book is one Marx repeatedly emphasizes. We fail in investments often because we think this time is different, only to realize later that this time is actually the same. Cycles are always there. Cycles are always there. As long as we respect cycles, understand cycles, and adjust with cycles, we won't be chasing the market's ups and downs in a panic, and we can become long-term winners in the market. By now, our understanding of cycles has probably shifted from seeing them as invisible threats to tangible companions. Many people fear cycles at first, thinking of them as moody enemies, making you greedy when markets rise and panicked when they fall, constantly disrupting your investment plans without warning. But after following Marx to break down the rules of cycles, analyzing 9 key cycles, looking at practical ways to navigate them, and understanding the cycles of success itself, you realize cycles are never out to get us. They are more like a friend who isn't very talkative but genuinely has your best interest at heart. Their fluctuations aren't meant to hurt you. They are reminders to adjust your pace. Their extremes aren't there to make things difficult. They are offering opportunities others don't see. Look at the seasons. Spring plants, summer grows, autumn harvests, winter stores. No one sees winter as the enemy. Winter isn't there to freeze crops. It lets the land rest and recover, storing energy for next year's harvest. Cycles work the same way. Economic downturns aren't meant to crush us. They push out bubbles and bring companies back to real profitability. Market drops aren't there to wipe out our money. They just pull overpriced assets back, giving later investors a fair chance to buy low. Even pullbacks after success aren't meant to deny our abilities. They are reminders not to get arrogant and to watch out for crowded trades. As Marx said during the 2008 financial crisis, without the cyclical drop, we would never have bought bonds so cheaply and wouldn't have made the big profits that followed. Many people treat cycles as enemies because they only see the bad side, losses during drops, missed gains during rises. But they forget, without cyclical fluctuations, there are no investment opportunities. If the stock market always rises, there's no chance to buy at low prices. If the economy is always good, there's no profit from post-crisis rebounds. It's like a friend who doesn't always indulge your occasional unwelcome advice. For example, when a cycle reminds you to reduce positions at the top, it might seem like you're earning less, but it actually helps you avoid bigger losses later. When it helps you buy at a low point, it might feel uncomfortable, but it allows you to catch the rebound that follows. Marx managed assets for decades, and he never fought against cycles. He befriended them. He observed the temperament of cycles. For example, knowing emotions swing to extremes, he stayed calm during greed. Credit moves from loose to tight, so he prepared before the window closed. He didn't aim to predict every step of a cycle precisely, just like friends don't calculate every move of each other. Knowing roughly how it will behave and being prepared in advance is enough. Buy less when valuations are high. Observe more when emotions are panicking. Pay attention when successful. Look for opportunities when failing. For ordinary people, there's no need to overcomplicate cycles, calculate complex models, or watch every single data point. Just remember, cycles are friends. They tell us through fluctuations when to be cautious and when to be optimistic. They use extremes to warn us not to follow blindly or get greedy. They use the alternation of success and failure to help us abandon the illusion of always winning and maintain our long-term survival. Finally, going back to Marx's point, cycles are always there. Since we can't avoid them, we might as well befriend them, follow their rhythm, and borrow their strength to navigate our investments more steadily and further. After all, what helps us get through one market fluctuation after another isn't luck, but this ever-present friend, the cycle itself. And finally, congratulations on finishing another book.